So, in this video, let's talk about such a simple thing as levels, regular horizontal levels. We all know there are several ways to draw levels. Why did price rise for some time, then some event occurred at a certain point, something changed there, and price bounced downward? According to a Google definition, at that point there was a redistribution of balance between buyers and sellers, and as a result, a level was formed there. Using Japanese candlesticks, we can only guess where exactly this event took place. That's why there are many theories about how to draw levels correctly, but all of them are just assumptions. In reality, we can look inside the candles and see what actually happened at those points. So, we choose the cluster profile chart type. Price was rising and a certain large volume was traded. If we zoom in, we can see larger volume values here. And volume is the amount of money that was invested into the asset from both sides. In reality, buyers and sellers met here in a struggle. Sellers won. The asset turned out to be too expensive at these price levels, and price moved downward. If we enable delta, we can see the dominance of delta here. Negative delta means real market selling. Positive delta means buying. When we see a large positive delta on the candle wicks, it means real market buys, and only market orders move the market, ran into limit sell orders that were placed here. In simple terms, sellers' limit orders absorbed the market buys, and price moved down. Therefore, the actual level is located where the large volume is. Again, proponents of candlestick charts may say this is a certain zone where an imbalance forms. But how do we actually see this zone? In reality, it looks like this. We see volume, and we see that the largest amount of volume was traded at this specific price level. This zone is the level, a zone where a certain event occurred, a redistribution of forces between buyers and sellers. Later, when a certain pattern forms at this level, we can enter a trade expecting that sellers still dominate there. If we extend this level forward, we see that later there was also a reaction, and that reaction was accompanied by volume at the ends of the candles. That means a large amount of volume was traded there again. Once more, market buys ran into limit orders. Buyers were not allowed to push price higher, and a pullback followed. Again, we can see that the largest volume was traded at this level. That means these are not candle bodies and not wicks. This is a specific area where the largest volume was traded. In other words, this is where buyers' limit orders were located. Limit orders, in fact, are placed everywhere, at all price levels, but in this area there were far more of them. Traded volume tells us this. And we can see that price reacts to this zone and then continues moving upward. We look at the volumes and see that after several bounces, such a volume level is formed, and price reacts to it at this point. Again, at this place, one could draw a level like this, or draw it like that, and all of this would still just be assumptions. That, for example, a seller was pressing price here, didn't let it go higher, price bounced, then there was a reaction and some movement occurred here. But when we switch to the cluster view, we see that most of the volume was concentrated in this area. Accordingly, even if we draw this area as a certain level, if some pattern had formed here, it would have been a signal to open short positions, if that was our intention. Ask yourself, what happened here? What happened at this point? What event occurred that led to the price decline? Price was rising, and then something happened that caused it to fall. What was the trigger for this move? Volumes show us that. It was a redistribution of positions, strong interest from both sides, a certain struggle between buyers and sellers, as a result of which we see a price decline. And if you analyzed only the candlestick chart and did not work with volume, you would not have seen this. We hope this short video allows you to look at familiar processes and events from a different angle. And perhaps you will find for yourself a new method of market analysis that is based on real volumes traded on the exchange.